G'day guys, welcome back to another update for gold and silver. Now, this is a prompt, if you like, from one of my viewers. Thanks, and I love you guys for prompting. It always makes me motivated to keep doing this stuff. But gold is still in a bullish momentum, and so in silver. But do watch that divergence. We've still got a bearish divergence in play, so expect a retrace anytime soon. In terms of the trading strategies we're going to demonstrate today, we did a video about a week ago. It demonstrated the CCI 14 at the top there, and also the CCI 350 in that video. So reference that video with links in the description below to learn a deeper dive into how to trade those particular strategies. And that's what we're going to cover today, those two strategies as well. In terms of the outlook, the uptrend in both metals is largely being underpinned by geopolitical risk, wars, trade tensions, sanctions. These risks are increasing the value of assets perceived as safe havens. Central banks are acting more cautiously, increasing viewing gold and to a lesser extent silver as insurance against currency risk, inflation and global instability. Monetary policy globally is in a state of transition. Inflation is still an issue in many regions, but there's increasing expectation that central banks, especially the US Fed, will ease or cut rates. Lower real yields favour gold and silver. Industrial demand for silver especially and the green energy transition are amplifying demand side pressures. Supply constraints for mining and logistics, environmental and regulatory are contributing to some tightness, especially for silver. So starting off with gold, this is the weekly chart on the left here, and the price has risen slightly since our last update. So you can see there on our last update, we're just going to extend that trend line. In the past week, it's risen slightly. And that's the target range of a bearish divergence. And back here you can see a very long-term bearish divergence. That's been happening now for a couple of years, since the start of 2024. And if that was a pullback, we'd expect a pullback somewhere in that range there. So again, no sign yet of a weakening. You can see the CCI is still above the moving averages, and so is the price. So still predominantly bullish trades on the daily if you're trading according to the weekly trend. On the daily, we had a resistance here at 32.47. And now I'm going to move that up to this new high there, and again that's right on the precipice of breaking through possibly. The CCI is still moving higher. That's a positive, and so is the price. So still bullish momentum, although that's a resistance we've got up there that we might see a bit of a bounce to the downside. Again, the price hasn't moved much higher than where it was previously. There's no divergence currently on the daily, so those highs have reached higher points than those previous highs on the CCI. And that's moving in alignment with the price. So at the moment, no divergence on the daily. On the hourly, however, you can see back here we had a bearish momentum on the CCI with lower highs versus higher highs on the price. Now, what's happened since then, since our last video, that CCI has risen slightly, but notice it's still on a downtrend. So what we're going to do is going to move that trend line as well to that new high. So that's still a bearish divergence. Now, of course, the price could keep rising, and the CCI could keep rising. And as soon as that keeps rising and breaks those previous highs, then we're going to invalidate the divergence. But at the moment, a cautionary, I suppose, viewpoint on that bearish divergence on the 1 hour time frame. Now, if you're going to the back test, again, this is the CCI 14 and the CCI 350 that, here on these two examples. We trade in direction of the daily. Now, again, reference the video, links in the description below to learn how to deeper dive into those. But very basically, you can see here we always trade in direction of the daily if you're trading on the hourly or any intraday time frame. You can see here, for example, this is a massive drawdown you would have had, and why heck would you have avoided that? So you can see there before that trade would have taken in this back test, that goes back to this period back there on the daily CCI. You can see that it broke down. As soon as it breaks down, that's your main stop loss area. As soon as a price goes up in that little area, you could have taken a long position, but as soon as that daily touches that CCI, you close out the position. Even if it's a loss, doesn't matter, that's your stop loss. So that's a bit better than putting stop losses on the predominantly on the hourly time frame, because it gives you a bit of breathing space. So let the strategy work. Now, having said that, let me just blow this one up for a moment. Notice here as well, we've got these. This is the hourly chart. We've got a lot of bearish divergence. I haven't got the CCI 150 down here, but we've got a lot of bearish divergence from the previous chart I showed you on the previous minute or two. You would have taken any closing out position. So you would have closed out your position there and avoided that little drawdown or consolidation. Another drawdown started, well, that would have started there from the daily. We would have avoided that. But again, notice here where we are at the moment. The 1 hour time frame showing a bearish divergence, so be very cautious. You can still trade these, But again, notice here single trades were taken, which is still profitable so long as the daily is higher. But always focus, again, notice back here, the dailies on the CCI and the price is moving higher. So that would have been a safer place to place those long trades. On the CCI 350 strategy, again, similar sort of thing, you would have avoided that drawdown with those contracts there, similar to what we had back here with that period back there. And then this one here, this major drawdown would have been avoided. Let's have a look at that. You can see back there on the daily, back here, it broke into that moving average range, and you would have closed out your positions on the hourly once you saw that, and that would have avoided that drawdown. Now, since then, ideally, you would have got into the trade at that point on the daily, breaking above the CCI and the price. And again, the CCI 14 strategy, because of its nature, would have generated a few trades during that period, whereas the CCI 350 is still waiting for it to break to the upside, and it just entered a position there. So that works on the CCI 350 breaking above its weighted moving average 100 is the main reason for that, not having as many trades in the last few days on the CCI 350. So for silver has similar patterns on the weekly and daily. You can see here the price on the weekly is still moving higher, but notice we've got the CCI 350 down here is also rising. But if I zoom out, you'll notice it's still lower than the opening point back there. So there's still a bearish divergence compared to the price, which is showing higher points on the price chart. So that's still a bearish divergence longer term on the weekly, although both that's still very bullish at the moment on the weekly, so you can take on the daily long trades if you're trading against the trend of the weekly. Remember, always trade in direction of the higher time frame. On the daily, if you're trading on the 1 hour time frame, again, since our last video, that CCI has risen slightly to that point, but still lower versus the price. Let's move this up there slightly. Let's get that to that point there. So that's still a bearish divergence on the daily, and also I'm going to move that resistance to that level. So that could be also another turning point. So I'll keep an eye on that. But at the moment, bullish momentum, but bearish divergence on the. So that's the daily. On the hourly, what we've got here, again, we had a bearish divergence there. You can see that broke down, hit our target range, the 23-38% range. Just touched it and then bounced, and that's all we need for that target range to be touched or hit. I don't trade these divergences, so just be careful because we don't know how far it's going to go. Sometimes they fail to touch that 23-38% range. Other times they fall right through. So it's hard to measure exactly. I use them as a potential exit point. So if I was going long during this period and I was holding manual trades, I'd be looking at potentially closing out my positions as soon as I start seeing a bearish divergence play out. Now here at the moment, the latest period, since our last video, you can see there we've got lower highs on the CCI versus higher highs on the price. Again, bearish divergence. And what that means, assuming it pulls back from there, it could go higher, of course, and if it does, we expect the CCI possibly to break higher, but that's why it's a bit hard to trade these divergences. So at the very minimum, we expect a retrace down near that moving average range. So I'll just draw a little target range there, the 23-38% range of Fibonacci. That's a minimum drop if it starts falling from there. Of course, again, it could still rise, but we don't know. But that's just if it starts pulling back from there according to this bearish divergence. Now, on the back tests, I've started back here on the daily around about the 20th of May on both of these, the CCI 14 and the CCI 350. And again, you can see there, this one's generated quite a nice little return. The baseline's 100,000. This one's generated about 428,000. Baseline here is 100,000, generate about 187,000. So only because there's less. Now you've got to be careful when trading with any particular strategy. I'm just giving you a couple of variations. The more entries you make and the more you average down, the higher the profit. So that's the risk profile you've got to be prepared for, and expect, if you're in the trade, expect some drawdown possibly if you don't get out of it. And that's why I always say, always follow the daily trend on the CCI and the price to make sure you exit the trade according to the daily at the very latest. But also paying attention to any divergence you might see. You can see there's a few little bearish divergence on the hourly time frame. So again, on this one back here, you would have, looking at the daily there, you would have closed it out because that CCI broke into that moving average range, and that was near the high there on the price. So the CCI gives you an early warning. you would have avoided going long any time during that period. You may have gone short possibly, and then that could have been a false break there possibly, maybe going short. The other reason I've got these moving averages as well, just to demonstrate the moving averages, the reason I've got multiple moving averages for those new to the channel, as opposed to a single moving average, is notice here, for example, it shows a concentration, if you like, or a consolidation of price movement, similar to the CCI. So that's a bit of a warning. Just be careful. Possibly you may want to avoid trading during that period. What I want to see is the moving averages move apart like they were back here. As soon as you start seeing the moving averages move apart, that's a safer place to go long in that case. So back here, for example, the CCI dropped below, but notice the price, it may, let's say assuming, let's go back here, for example, the price dropped below and so did the CCI. Now, I wouldn't have gone short there because notice here, the CCI, the moving averages were still quite wide apart. Again, I'd like to see the moving averages break to the downside like they were here. So again, that could have been a potential trade on the hourly if you're trading in accordance with the daily, and you may have got in with a couple of short trades during those 2 days of trade possibly, or at the very latest closing it out with a small loss. So that's why I like to see these moving averages bending up like they were back here again, trading on the hourly to take long trades during that period, and again closing it out when the CCI touches that moving average band near the top there. So that's the general rule of those moving averages and why I like to use multiple moving averages. So again, closing it out with to reduce the or to minimize any losses if you get a potential multiple drawdown whenever the daily breaks into those moving averages. And again, you can see that happening in each of those points. But also do pay attention to any bearish divergence on the hourly and get out of long trades in this case when you see a bearish divergence play out, as I said. Make sure you hit that like and subscribe and share buttons. And if you enjoy the content, subscribe at least on a free trial to my Patreon page where I publish weekly bullish shares across various regions of the world's markets. Thanks, and talk to you in the next video.